Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to always share evidence-based holistic insights to help you master the game of building wealth. And today I would like to talk about some meaningful ideas around tax reform. Now, Jim Chalmers, the Treasurer, has acknowledged that both state and federal budgets are under unsustainable pressure, and that achieving budget sustainability cannot be done without both raising taxes and cutting spending. Interesting that there was a federal election recently and there was no talk, of course, of raising taxes. Funny that, hey? Anyway, Australia does need tax reform, and it needs tax reform that's going to support economic growth rather than stifle it. And often growing the tax base really allows the economy to grow and the country to thrive, whilst also still raising overall tax revenue at a dollar value point. Now, today, I'm not going to suggest that I've got all the answers. I don't know if anyone really has all the answers, to be honest, but I do believe the government has an opportunity to be quite bold with this potential tax reform. Let's face it, they've virtually got no opposition, with the coalition really struggling, of course. And major tax reforms always face strong resistance. We've got to expect that. So even the best ideas are going to receive a little bit of pushback. I mean, think about when Paul Keating introduced compulsory superannuation in the early 1990s. That wasn't popular, of course. John Howard's introduction of the GST in 2000, again, not popular. I think the key thing here is just to remain open-minded and trying to be as forward-thinking as possible to position Australia so it can thrive over the coming decades and incentivize the entrepreneurial spirit in terms of innovation and growing business, as well as then balancing, of course, the other priorities that a government has around welfare and equality and these sorts of things. Now, Chalmers has also acknowledged that we need to reduce our reliance on income tax. Income tax has negative consequences for the economy. Of course, it reduces the incentive to work harder or work more, because the more you work, the more tax that you pay, of course. And because we're taxed on income and then again on investment returns, it discourages saving and investing, both of which are vital for the long-term economic health of Australia. And finally, income taxes are less effective in an aging population because a greater share of the population is no longer working anymore, and that really describes most developed economies around the world. In contrast, consumption taxes are less distortionary because you only pay tax when you spend the money, so there's an inbuilt incentive to either save or invest, which again is good for the economy. Also, arguably, compliance is a lot simpler as well. Bracket creep is a big problem in Australia. That's where wages are rising with inflation, and as a result, more people are pushed into higher tax brackets, even though their real purchasing power hasn't really changed. That's because marginal tax rates are not indexed to wage inflation, which they arguably should be. And as a result, the average tax rate in Australia is expected to be 24.3% in the 25 financial year. And if nothing's changed, as in the tax brackets don't change, it's projected to rise between 27 and 28% by 2033, which is a record high. It's already a record high. And just by comparison, in the 2009 financial year, the average tax rate was 22%. So this is the tax rate that is actually genuinely paid. So it's looking at sort of taxable income and the amount of tax that's levied on that income. So that bracket creep means that we're all just paying higher taxes. I'm going to resist the temptation to talk about how the government might want to reduce their expenditure and therefore take the pressure off the budget, but we'll leave that. I like to be as apolitical as I possibly can, so we'll leave that for perhaps another day. Now, there's a really interesting article in The Economist. Of course, the link is on the blog on the website, and the link to the blog is in the show notes as always. So there's a really interesting article in The Economist that talked about zero-sum thinking. And that means that it doesn't necessarily have to be that if I pay more tax, I'm automatically worse off. And we can't always think like that with respect to taxation. Sometimes paying a little bit more tax on an overall basis can still put me better off. I mean, ultimately, it's around the betterment of the country. And if the country is going to be stronger and more stable and have more economic growth and more opportunities, then we all really benefit from that. A good recent example, in my opinion, is the superannuation guarantee. So over the last 4 years, it's increased from 9.5% to 12%. So that means that an employer's superannuation bill over the last 4 years has increased by 26%. It's not often spoken about because it's really an impost on the commercial sector to really fund everyone's retirement. Now, no business welcomes higher costs, and no business welcomes a 26% increase in costs over a relatively short period of time, being 4 years. But I'd argue this change actually benefits all Australians, including business owners, because by lifting the proportion of self-funded retirees, currently around 43% of Australians are self-funded, we ease the burden on the welfare system in the long run. And ultimately, that reduces the tax load on future taxpayers as well. And helping employees secure retirement is, I think, in everyone's interest. And the benefit of superannuation is it goes directly to the employees. It's not like I'm paying into the government and who knows where it's going to be spent. At least we know it's going to go directly to the person to help them fund their own retirement, as I said, so there's a less of a burden on the welfare system. So therefore, as we debate tax reform, I think we've got to put aside this zero-sum mindset and just don't think about ourselves, but think about the country as a whole and the secondary benefits of these changes in tax legislation. And some of the examples that I'm going to share, it might mean that individuals might end up paying more tax, but on an overall basis, it might still be in their benefit. So what I wanted to do today is share some of the ideas that I've been thinking about in regards to taxation reform. And as I said, I would hope there's a great opportunity for the government to be bold with this, bold as things like the GST, bold as things like the superannuation system, and so that we can look back in 20 years, 30 years and go, wow, that was a really positive change. I'm not optimistic they're going to be this way, but let's think about some bold changes that we can make. One of the challenges with housing affordability is supply, of course. I mean, it's something that, people talk a lot about in terms of we're not building enough new homes. And whilst building new homes is very important, and I agree, it's a critical element, it's not a solution. It's not the only solution that we need because, of course, we can only build new homes in certain locations, but there's demand in other locations like established suburbs, close to the city, all those sorts of things. And given that private investors provide around about 84% of rental accommodation in Australia, we're really relying on the private sector to be able to fund an increase in rental properties. And I think this creates an opportunity for the government to incentivise long-term property investors to provide more affordable accommodation. Now, back in 2015, the government canned the National Rental Affordability Scheme, NASRA, it was called, is the acronym, and that gave tax credits to investors who built affordable housing. So a modernised version of this that can be targeted towards established dwellings. And remember, established dwellings are going to be, in more dense, already established locations. It's great, as I said, great to build new houses, but not everyone wants to live, 40, 50 k's away from the CBD. So a more modernised version of NASRA could extend this scheme to provide some sort of tax incentive to property investors that rent their properties out below market value. And a part of or function of this scheme could even be to give renters a little bit more security over their property. So maybe entering into sort of 5-year leases or even 10-year leases, for instance, in return for some sort of tax benefit. Now, what could the tax benefit be? Well, the tax benefit could be additional negative gearing benefits. So perhaps you can deduct 120% of the negative cash flow against your income to, defray some of the cost associated with renting below market value. Perhaps if you are able to rent that property below market value for a period of 10 years or longer, that you get a larger discount off the capital gains tax, so more than 50%, 60, 65, 70, I don't know. I don't know what the numbers are. But I think there's clearly a need there that if we've got a certain sector of the economy that is private investors providing 84% of rental accommodation, we know that we need new rental houses, yes, but we also need more rental houses in established locations to accommodate the population growth that we've got. We need to incentivize investors rather than create disincentives like additional taxation liabilities that the states have been very good at doing. My next idea is around super and contributions tax. There's two key points I want to highlight. Firstly, there's only sort of two rates at the moment inside super. So if you earn up to $250,000 a year, the first dollar that you contribute into super and the last dollar that you contribute into super is taxed at a flat 15%. If you earn more than $250,000, your contributions are taxed at a flat 30%. However, if someone is earning $45,000, their average tax rate ends up being about 11%, which is lower than what they taxed inside super. So in fact, the current system disincentivizes lower income earners from putting any money in super. Aren't they the people that we should be incentivizing the most to save for their retirement? And of course, it makes it unfair that higher income earners are getting a tax break and lower income earners actually end up paying more tax to put money into super. The second observation that I want to share is it's a race to $200,000, really from a balance accumulation perspective. Once your balance reaches around about $200,000, your investment returns start to match your contributions or even exceed your contributions. And so that's when investment returns start to become more important and you get that compounding capital growth. So really what we want to do is create a tax system that really incentivizes Australians to get to $200,000 as fast as possible, where possible. And so what I think they should do is there should be no contributions tax if your balance, your total super balance is less than $200,000. And then you can tax people at 15% if your balance exceeds $200,000 and still the 30% if your balance exceeds $200,000 in your income is higher than $250,000. So no changes there. It's just really an additional tax break to those Australians that have less money inside super. And that way, someone that's earning $45,000 will be 11% better off in terms of avoiding tax by putting money inside super, and you get rid of this silly situation where it's actually a disincentive, again, probably for people that would benefit the most from saving monies towards retirement. Okay, my next idea is around consumption taxes, that is the GST. You know, one of the criticisms of consumption taxes is they're regressive. They're regressive in that it means that lower income earners tend to pay proportionately more GST than higher income earners. And that's just simply because a lower income earner is probably spending most of their money on living expenses, which most of which attracts GST, where, say, a very high income earner, someone earning $1 million a year, they might be spending $100,000 a year, so they're spending 10% of their income and proportionately relative to their income paying less GST. And that's why the criticism around consumption taxes is regressive. Also, separately, as we've experienced through this challenge of battling inflation over the last few years, or the RBA trying to battle inflation over the last few years, we've experienced that monetary policy isn't particularly fair. In that, again, lower income earners are unfairly or disproportionately impacted by higher interest rates, whereas self-funded retirees and people on very high incomes doesn't worry them that much. They just keep on going out and spending money and causing problems or making it more challenging for the RBA to cool inflation as a result of increasing interest rates. So one solution to this could be to introduce a luxury rate of GST. And this could apply to discretionary spending, things like holidays, eating at fine dining restaurants, alcohol purchases, luxury goods, really all the things that we enjoy. That would dampen the regressive nature of GST and I think better support the RBA with using monetary policy to cool or stimulate demand. Now, of course, there's going to be some industries that are going to be adversely impacted by this change. So, of course, would need some sort of temporary support from government to help them adjust to the kind of new normal or the new settings. To further combat the regressive nature of GST, the government could offer GST credits to low income earners. So similar to Singapore's GST offset package. So again, to help those lower income earners not pay as much GST. Now, let me be clear, this would only make sense if it was part of a broader reform package that materially reduces income tax rates. And in effect, what I'm suggesting we do is shift more of the burden from the income tax system onto the consumption tax system. So away from income tax onto GST. And that way it's discretionary, right? I'm going to pay less income tax. I can then either save or invest those monies, which is good for the economy, or I can go out and spend it on luxury items or discretionary items, which is also good for the economy. But if I choose the latter, there's going to be a tax consequences associated with that decision. Okay, the next idea I have is capping the main residence capital gains tax exemption. I think it's arguably one of the biggest tax loopholes in Australia. And the logic behind it's pretty reasonable, of course. It's because you didn't buy your home primarily to generate wealth or generate income. Any interest on the mortgage is, of course, not tax deductible. And of course, therefore, neither should any capital gains that you make should attract tax. I mean, that stands to logic. What's not fair is the tax-free status is unlimited. So, for example, if you look back a few years ago, someone sold a mansion in Point Piper and it was reported they made a $19 million gain in just 4 years. And that's a tax-free gain. Now, surely we could all probably agree that the person that was able to achieve such a significant gain in a relatively short period of time can probably afford to pay a little bit of tax. Now, what could that look like? Well, the government could introduce a lifetime cap on the main residence exemption. So, for example, the government could allow maybe a generous lifetime exemption of, say, $5 million. So you buy and sell your home, your primary place of residence over your lifetime. You eat into that $5 million tax-free capital gain. But as soon as you use that up, maybe you start paying some tax. And the capital gains tax that applies doesn't necessarily have to be at standard interest rates, so standard tax rates, I should say. It could be that instead of getting the 50%, the general 50% discount, if it's your home, your main residence, and you've exceeded the lifetime cap, maybe you get a 75% discount. And in that case, if I refer back to the Point Piper owner, out of the $19 million, they'd end up paying $2.3 million in tax. So I'm not saying let's whack them with a heap of tax, but at least take some of that tax and also close that loophole for ultra rich people to have a free kick in terms of not paying any tax on making substantial capital gains on real estate. And of course, something like this would start working as a bit of a quasi-inheritance tax, I guess, and capture some of the intergenerational wealth transfer that is occurring, particularly in the ultra-high net worth category. I don't think that's such a bad thing. Now, they're always talking about, with respect to property investors, negative gearing and capital gains tax. So what changes could be made there? Well, with negative gearing, instead of abolishing it, which I think would be really dumb, it's going to reduce the supply of rental properties in Australia. And as I said, 84% of supply is from private investors. So that's a really negative outcome for the market. But I have over the years seen some people, some investors gear so heavily that they've got no taxable income. And so you might have someone earning a few $100,000 a year and not paying any tax just because they've geared to their eyeballs, which I think is a really dumb idea, by the way, because as you move down the tax rates, of course, there's the negative gearing benefit evaporates. I think having a tax system that allows people to do that at the extreme doesn't make a lot of sense to me. So perhaps capping negative gearing could be a good idea. Cap it at $50,000 a year per individual or something like that. And then if you have losses over and above that you can carry forward those losses and offset them against future income. I think if you're going to cap negative gearing, you'd have to cap it excluding state taxes, because one of the challenges over the last 10 years, as Campbell will get into in a few weeks' time, is that land taxes increase so much that it'd be unfair then to charge someone land tax but then not give them an immediate tax deduction for it. So you could cap negative gearing excluding land tax. And with respect to capital gains tax, one of the criticisms is that it's too generous, that as soon as you hold the property or asset for more than 12 months, you get an immediate 50% discount. Well, the way to deal with that could be to give an extra 5% discount for each year you hold it between years 0 and 11. So, for example, if you own the asset for 1 to 2 years, you get a 5% discount. If it's 2 to 3 years, you get a 10% discount. And so on and so forth until year 11, you get the full 50% discount. And that way, the capital gains tax regime will then work like the old index method where you had to index the cost base and then you were taxed on the differential there. At least that would also dissuade people from speculating in markets, buying and selling, speculating in property markets. And as a result, long-term investors are rewarded also. Now, of course, I'm not a politician, thank God, economist or social scientist. None of these ideas have been costed either, of course. I'm just sharing these ideas as an example of how a government could be quite bold with tax reform that is both efficient and fair, a tax system that helps the country and the economy thrive, that promotes people to be entrepreneurial, to grow businesses, to invest in themselves, and overall just for us to become a smarter and more successful nation, while still looking after vulnerable and disadvantaged Australians. Now, what's the chance of it happening? Well, I think politicians these days are more interested in being seen to do something rather than actually doing it, and also focusing on the results of the next election. So a bit of pork barreling, I'm sure, will go on. Jim Chalmers, as I said at the beginning, has said it's got to be a combination of raising taxes and cutting spending. I don't think they're going to cut spending. I definitely think they're going to raise taxes. And as a general conversation for investors that might be worried about that, don't worry. Taxation has changed a lot over the last 30 years and it doesn't worry or interrupt investment strategies. Typically, a good quality, evidence-based investment strategy will still weather any changes in taxation. And also, if some things are changing, doesn't mean they're going to be changed forever. So I wouldn't be making too many crazy reactions, but of course it's something we'll follow. And if there are changes, I'll certainly be talking about it in the podcast. Okay, let's get in some questions. First one is a good one. I mean, they're always good ones, actually. The listener would like to remain anonymous, which is completely fine, of course. The listener is a GP, a doctor, single, teenage sons. Actually, I added that sons. It's just two teenagers, 15 and 17, and she is 45, immigrated to Australia in 2009. Income is 300 to 350. Just finished a reno on the home worth about $2 million with $150,000 of debt, which was used to fund the renovations and not a lot of debt against the home. 3 investment properties worth 2.1, one in regional New South Wales, one in Brisbane, one in Perth. Debt of 1.15, rounded off. 280,000 in super. It's low because obviously she had children and really started looking at in her mid-30s. Mortgage broker has said that borrowing capacity is between 7 and 800,000 and wondering if she should buy in a family trust. And she cited, the fact that negative gearing is trapped into a trust, but also maybe the benefits of asset protection and also preserving borrowing capacity. Okay, so there's a lot here, really. I mean, the first observation is, what have we got? About sort of just under $1 million of equity in the 3 properties, but I'm going to guess that they haven't been owned for, a couple of decades or anything. They're probably relatively recent purchases. So let's call it, for the sake of rounding off, $1 million in property and 280 in super. And she's 45, so 15 years away from retirement. We've got way too much money outside of super and way too much money in property. So I'm not saying that as a negative thing. That's a great thing. But what I'm saying is, if we don't have a strategy around it, what we're going to end up with is a disproportionate amount of wealth outside super versus inside super, which is tax ineffective, which I've spoken about previously. Let's talk about buying property in a trust. Let's talk about asset protection first. Well, in this scenario, the client's got a home and about $1 million of equity in property. Super is protected from a trustee in bankruptcy. So if you get sued, your super's still protected no matter what. But this person has still $3 million of assets to her name. If she's going to be successfully sued for whatever, and if it's related to her work, firstly, professional indemnity insurance is very deep cover, and there's limitations on liabilities as well in terms of the time horizon that a patient can take action. And there's, to my knowledge, been no event where a insurer has decided not to pay a benefit and the insured has suffered a personal loss. So let's put all this in context in terms of what asset protection risk do we really have. And I should say, over almost the last 25 years, I would say, as a general observation, asset protection is overstated as a risk. Wildly overstated as a risk. I haven't in 25 years seen someone being sued to the extent that it caused them any material financial harm, which is not to say it's never going to happen, of course, but I would say that most people that are talking about asset protection are accountants or lawyers that want to overcomplicate your structures. So I wouldn't worry about asset protection. I don't think it's, unless there's something that is specific in your circumstances which you haven't told me about, but if it's really just your profession being a medical practitioner, I generally don't have any concern with respect to that. Professional indemnity insurance provides very deep cover. The negative gearing is certainly trapped inside a trust, which is very valuable. It's more valuable than saving capital gains tax. So, because capital gains tax could be a saving in 20 years from now, negative gearing is a benefit today. And that's come out of, previous financial modelling that I've done. And the other thing that hasn't been mentioned is higher rates of land tax inside a trust. So I almost never recommend owning property inside a trust. And in this person's position, I'm not even sure I would add a fourth investment property. I think what that does is only exacerbate the disparity of wealth inside and outside of super. So what I would probably do is start making additional super contributions. You're 45, so I don't think and your kids are a little bit older now, so I don't think it's too early to do that. You're probably maximising the concessional cap, which is the tax deductible contributions, $30,000 a year. If you're not doing that, you should. And then you can contribute up to another $120,000 a year into super via non-concessional contributions. So I would probably, repay the home loan first. But once the home loan is repaid, I'd probably put a little bit of money into the offset accounts of the investment properties just to build that cash buffer. And then I'd probably put the rest into super via a non-concessional contribution, just assuming that, your super is well invested in that it's with a good fund in a good investment methodology. Of course, I've recorded a lot of episodes over recent weeks about superannuation. And then what I'd do is I'd monitor the performance of the 3 investment properties. So as I said, one in regional New South Wales, one in Brisbane, one in Perth. I think Brisbane and Perth will keep running. Who knows about the regional New South Wales property? But I would keep benchmarking returns, just monitoring, seeing how they're performing. It's never going to be straight line. It's never going to be smooth. But if you then formed an opinion that one of those properties in terms of future returns are going to be lower, I would divest of the property and then take the equity and put it into super as well via non-concessional contributions using potentially carry forward. And then over the next 15 years, hopefully you keep a couple of the really good properties, you move some more money into super, you make non-concessional contributions. And I think if you do that, you're probably going to put yourself in a good position where you're able to have a good balance of wealth in terms of what's in equity and property versus what's in super. Now, the listener did mention about, her kids. The difficulty firstly, I would say develop a strategy, the best strategy for you first, right? Making yourself financially strong as possible and as secure as possible puts you in the best position to help children if and when they might need it down the track. Prioritizing kids too early could result in making a mistake in choosing an option that's not the most efficient option. And as a result, potentially retard your ability to help them down the track. So I always say to parents, look after yourself first, get yourself into a position where you hopefully have surplus wealth. And then when you have surplus wealth, you can then potentially help your children down the track. Also, I've spoken about before, it's very difficult to predict when each child will need that help. Most parents are of a mind to help each child equally. I get that, but equally doesn't mean necessarily in the same way. and it doesn't necessarily mean at the same time. And so that's really difficult to judge. One child might need or would like to get into the property market when they're 22. The other child might be traveling, doing other things, might not even be on their radar until early 30s, right? It's just too hard to plan around it. So you look after your own strategy first. You do the best for you. And then if you do that and you do that successfully, you are going to be in a position where you're going to be able to help children in whatever way's going to be best for them. So thanks for writing in that question. Good question, and might leave it there for today. Next week, I think I've got an interesting episode for you where I'm going to talk about long-term property data and delve into median house price changes over the last 5, 10, 20, 30, 40 years, 45 years, and analyze that performance and try and solidify it into something that's actionable for investors. But until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.